China is currently our second-largest trading partner. The U.S. is implementing a 25% tariff on all cars not made in the United States, while cars manufactured in the U.S. will not be subject to this tariff. The U.S. has ongoing trade disputes with China, and as one of the world's largest trade players, it has recently intensified tariffs, particularly on Chinese goods. These actions are shifting global economic dynamics. The U.S. has been announcing increased tariffs on China since the beginning of 2025, marking a potential reignition of the trade war with new tariff packages introduced in early April. This situation has raised concerns among U.S. allies, including the European Union and Canada, with some questioning whether continued cooperation with the U.S. is beneficial. As tensions rise, there are discussions about the possibility of turning to China's vast market. While some experts see the value in shifting focus towards China, it remains uncertain whether Europe and Canada will move their trillion-dollar trade from the U.S. to China. Public opinion in the EU and Canada is increasingly critical of the U.S.'s protectionist policies. In these regions, surveys show that 55 to 60% of citizens disapprove of the trade wars initiated by the U.S., arguing that excessive tariffs harm businesses and inflate product prices. In Canada, particularly following the Biden administration's moderate approach, there are concerns that the U.S. arbitrarily changes trade rules. As a result, there is growing interest in seeking new economic partnerships, including with China. China, for its part, plans to further open its market to both the EU and Canada. Beijing has long been interested in strengthening ties with Canada, particularly in energy resources like oil and LNG, and in pursuing joint high-tech research and development programs with Europe. Economic experts suggest that the annual trade volume between China and the EU is around $800 billion and could grow with the inclusion of Canada. In Canada, the possibility of selling oil and LNG to China rather than the U.S. is being discussed, as U.S. tariffs make it difficult to access the American market. Similarly, European automotive companies are considering expanding their market share in China to compensate for losses caused by U.S. tariffs. EU-US trade reached close to $1 trillion in 2024, with $450 billion in U.S. exports and $545 billion in EU exports to the U.S. Canada's trade with the U.S. stood at $42 billion. However, ongoing tensions and threats of tariffs against the EU and Canada are prompting reconsideration of economic strategies. Some believe that collaborating with China, which offers lower production costs and access to a larger market, could be a more profitable long-term option. Although the future remains uncertain, public sentiment continues to favor exploring alternatives to U.S.-centric trade. This suggests distancing from the U.S. Some people speak not of a complete separation but of a strategy to focus more on China and reduce reliance on the U.S. Canada heavily depends on the U.S. for oil, LNG, and electricity exports. Figures show that in 2024, Canada's oil and gas revenues, amounting to around $100 billion, were largely derived from the U.S. market. If Trump's tariffs or other trade-related sanctions complicate this flow, Canada might explore major projects with alternative buyers, such as China, the EU, or even Japan. However, this transition would be costly, requiring new pipeline and LNG infrastructure investments. Opinion polls in Canada show that up to 60% support non-US pipeline projects, expressing frustration with the Trump administration's trade policies. Many believe it is in the national interest to diversify into broader global markets. The Canadian government may also be gaining voter support by framing this as a move towards strengthening strategic independence from the U.S. On the U.S. side, there is resistance, as trade volumes with Canada are already substantial. Critics question where else Canada could turn, but reactions to Trump's tariffs seem to be intensifying. The situation is similar in the European Union. Germany, for instance, relies on the U.S. market for a significant portion of its automotive exports. If Trump continues to impose high tariffs on EU cars, German manufacturers may consider expanding their market share in China instead. Similarly, countries like Italy, France, and Spain are frustrated with U.S. protectionism, particularly regarding agricultural and food products. The EU may increasingly focus on China's vast market. Some European officials suggest that the EU Commission could be revising its long-term trade projections to reflect a decline in the U.S. share and an increase in trade with Asia. Of course, rapprochement with China raises other issues, such as concerns about intellectual property and human rights. Yet, the question remains whether economic self-interest always takes precedence, and answers within the EU vary. As the Trump administration's tough stance on China continues, there is talk that the tariffs imposed on April 2, 2025, could range from 34% to 50% on Chinese products, compared to the previous levels of 10% to 20%. These tariffs could, in total, reach 104%. China has reacted strongly, calling it an embargo, and both the EU and Canada are concerned that such measures could push the global economy toward recession. There is increasing discussion of cooperating with China for mutual interests, rather than with the U.S. According to British media, this trend may have moved from theoretical discussions to actual projects at the state level in the EU and Canada, with sectors like agriculture, mining, rare metals, automotive, oil, gas, and LNG being the primary areas of focus. For example, China already holds a dominant position in the rare earth market, and closer cooperation between the EU, Canada, and China in this area could challenge U.S. dominance in the tech sector. Additionally, the size of the EU and Canadian markets makes them attractive partners for China. The European Union, with a population of around 450 million, has high consumption levels, while Canada, though smaller in population, holds vast reserves of energy and natural resources, making it a potential alternative supplier to the U.S. Trade links developed between the EU, Canada, and China might prompt concerns in the U.S. about its market share. Questions are being raised on social media about whether the U.S. will take further steps to counter this shift. Could Trump offer attractive deals to dissuade the EU and Canada from pivoting toward China? Given the ongoing tariffs and protectionist rhetoric, however, Europeans and Canadians may begin to question why they should continue trading with such an unstable administration. Is this shift feasible in the short term? Experts argue that a complete break is not easy. EU-US trade is worth around $995 billion, and Canada-US trade totals about $400 billion, making it politically and technically difficult for these figures to suddenly shift toward China. However, Some argue that even a small shift of 5% per year could have significant economic implications. For instance, if EU companies set up production lines in China and Canada builds new pipelines and LNG facilities aimed at Asia, a less US-dependent economic structure could emerge within 5 to 10 years. If the US underestimates the EU and Canada, it could lose significant market share in the long term. This assessment is gaining traction on social media.